Welcome back to Wander and Invest. In this series, we're covering everything you need to know to start building wealth, even if you're getting started a little later in life. Today, we're diving into one of the best ways to grow your savings while keeping more of your money working for you. Tax-advantaged accounts. Before we get started, a quick disclaimer. This video is for educational and informational purposes only. While the strategies we discuss are effective, everyone's financial situation is different. So consider speaking with a financial advisor to make the best choices for you. First, what exactly are tax-advantaged accounts? These are special accounts designed to encourage long-term saving by giving you tax breaks on your contributions, your investment growth, or both. Tax-advantaged accounts help you keep more of your money invested over time, which can make a big difference in reaching your financial goals. The three main types we'll cover are the 401k, traditional IRA, and Roth IRA, each with its own tax benefits and contribution rules. Let's start with the 401k, which is an employer-sponsored retirement account. With a 401k, contributions are made pre-tax, meaning you don't pay taxes on that income now. Instead, your money grows tax-deferred, and you'll only pay taxes when you withdraw in retirement. One of the biggest perks of a 401k is the employer match. Many employers match a percentage of your contributions, so be sure to contribute at least enough to get the full match. It's essentially free money added to your retirement. Scenario 4, employer match on 401k. For example, let's say you make $60,000 per year and your employer offers a 50% match on the first 6% of your salary. If you contribute 6%, that's $3,600 annually. Your employer will add an additional $1,800, giving you $5,400 toward retirement each year. In 2024, the employee contribution limit for a 401k is $23,000, or $30,500 if you're 50 or older, with a $7,500 catch-up contribution. In 2025, the limit rises to $23,500, with the catch-up contribution increasing total employee contributions to $31,000 for those 50 to 59 and 64 or older. If you're between the ages of 60 and 63 in 2025, you can make an even larger catch-up contribution of $11,250, raising your employee contribution limit to $34,750. One thing to keep in mind is that some 401k plans come with higher fees, often called expense ratios. Over time, these fees can add up and reduce your investment growth. When reviewing your 401k options, look for low-cost index funds, or ETFs, within the plan if they're available. For example, if you have a choice between a high-fee mutual fund and a low-cost index fund, like an S&P 500 ETF, the low-cost option can help keep more of your money working for you over time. Next up is the traditional IRA, an individual retirement account that anyone with earned income can open. Like a 401k, contributions to a traditional IRA are typically tax-deductible, which reduces your taxable income for the year. This can be especially helpful if you're in a higher tax bracket and want immediate tax savings. Scenario 4, low to mid-income saver. If you earn $50,000 a year, contributing $6,500 to a traditional IRA could reduce your taxable income to $43,500. This means you're paying less in taxes now, and your investments can grow tax-deferred. The 2024 and 2025 contribution limits for a traditional IRA are $7,000 if you're under 50 and $8,000 if you're 50 or older. Now let's talk about the Roth IRA, which is especially popular for younger or lower income earners. With a Roth IRA, Your contributions are made after tax, meaning you won't get a tax break now. But here's the huge benefit. Your money grows tax-free, and you won't pay taxes on qualified withdrawals in retirement. This makes the Roth IRA a powerful option if you expect to be in a higher tax bracket in the future or want to build tax-free income for retirement. Scenario 4, mid-income saver. Eligible for Roth IRA. For example, if you're a single filer making $80,000 a year, you're under the income threshold to contribute the full $7,000 to a Roth IRA. If that $7,000 grows to $50,000 by retirement, you can withdraw it all tax-free, a huge benefit. Now, what if your income is too high to qualify for a Roth IRA, or you want to contribute even more? There are two strategies that high-income earners can use to take advantage of Roth accounts: the Backdoor Roth IRA and the Mega Backdoor Roth. Backdoor Roth IRA. With a Backdoor Roth, you contribute to a traditional IRA and then convert that money to a Roth IRA. This strategy works because there are no income limits on conversions, allowing high earners to get Roth IRA benefits even if they don't qualify directly. Mega Backdoor Roth. If your employer allows after-tax 401k contributions, you may be able to use the Mega Backdoor Roth strategy. Here you contribute after-tax dollars to your 401k, and then roll those funds into a Roth 401k, or Roth IRA. This can allow you to save thousands more each year in a tax-advantaged account. Tax-advantaged accounts can play a powerful role in your wealth-building journey, and by understanding each option, you're setting yourself up for a stronger financial future. Remember, every dollar saved on taxes is more money working toward your goals. In the next video, we'll cover ways to stay consistent and make adjustments as you go. Be sure to subscribe so you don't miss it, and let's keep building wealth together with Wander and Invest.